Hello guys, today I'm going to discuss hedging your trades. It comes from a familiar phrase saying hedging your bets. So while we are not encouraging mindless trading, we are considering uncertain markets, and when it becomes uncertain, we are looking for trading opportunities. I want to discuss trading opportunities as it pertains to watching for a change in market direction. Why does that matter? Because large movements can go on precipitously. We are presently experiencing some precipitous movements in certain stocks. And if you assume you're in a bear market that's never ending or can't determine where it will end, your temptation will be to pile on, which inevitably could result in a missed opportunity or a swing trade in a reversal. So some call it short covering, some call it, calling a bottom. Why is hedge trading important? That's what I want to look at in this video. In a nutshell, some stocks that we're looking at approaching 52-week lows are generally not stocks that I would, try to call a bottom on, because the word from the wise is, don't don't trade at 50-week lows in the wrong direction. However, uh, you know, people that are late to the parties may start piling on a short position and realize that was a double bottom. So how do we protect against a situation where we want to be prepared for a change in direction and capitalize on it? My first example today is an all stock called MRO. It's approaching 52-week low. A couple of weeks ago, I predicted it would go down to 18. It is about $22 now. The price of that option is only about 22 bucks. So I've held that position. It's maintained value around 22 bucks for about a week. Now's the time to consider hedging my bet. This might be what I call an inverse hedge. I'm considering buying a long call in the September-October timeframe, in addition to the one that I've already put on, which was a shorter September-October calendar. What does that mean? I do expect the stock to change direction sooner or later. If it happens to continue to go down, my $18 to $20 put, calendar put is going to gain value. My relatively inexpensive call is going to expire worthless. But because we're moving in the down direction, you can certainly anticipate the call position for September, October is going to be even cheaper than my puts. Looking at our first example, I want you to take a peek over at the chart here. I've got about a 7-day chart for MRO, Marathon Oil Corporation. We are looking at a stock that is headed in the downward direction. You'll notice at the left of the charts, this chart is trading, 22, 23, 24 bucks, and toward the right, which is present time, it is trading closer to $22. We're looking at indicators of the stock direction that you may be familiar with, but I want to review them as this is an introductory video on swing trading, hedge trading, and so on. First, we'll look at the color of the candlesticks. The candlesticks are either white, which are progressively going up, or red, which are progressively going down. If we were to look at this chart and compare the beginning price on the left with the closing price on the right, we'll notice the stock is trading today lower than it was 7 days ago. There appear to be clearly 3 big red bars, and there appeared to be 2 to 3 clearly white bars. But you'll notice that the bars, those white bars, especially at the beginning, are really outnumbered by those red ones. If we look at the current day bar, we can examine what is called stochastic indications. A stochastic indicator wants to compare the closing price with the high or low of that day. So looking at today, we look at the closing price. It is in a red candle, which means We were going down pretty much progressively all day. The closing price, as you can see, is pretty much at the bottom of that day. We've noticed that there are a couple of other red bars on that chart in the past couple of trading days. So what you might suggest is that this stock has begun what amounts to a progressive regression or a direction down. The first couple of days, it was fairly stable between $23.50 and $24. Again, at the beginning of this presentation, I suggested that I would put on a calendar bearish position in the September-October timeframe with a price target of $18. Paid $22 for it approximately. That is to say, the short position I sold for about $70, and the long position I sold for about $50. The net purchase price of $20. Again, I sold the September $18 put for about $50, and I bought the October $18 put for $20 more. Today, that position is trading at about $19. That is what I will consider as part of a hedge trade. There's going to be two trades in the hedge: one vertical trade or bullish trade, and a bearish trade. These matter when you're in the middle of a price trend. So if I'm in the middle of a bull market and I'm projecting that the stock will go up, well, then I have room to grow. I have room to capitalize on it. If I'm unlucky and the stock starts changing direction, basically I've lost out, and I've lost that trade. Hedging effectively means, in certain cases, I'm anticipating not knowing how soon or how long this trend will continue. So while the stock is going up, I'm putting on a shorter position, and that protects me. Much like stopping out of a trade, putting on a short position allows you to benefit from a sudden change in direction. Today, we're looking at stocks that are trending down. So my initial position was a bearish position on MRO, $18, some 4 months away. Say we're in May, June, July, August, September. I'm predicting the next 3 months that the price of oil will continue to go down during a weaker than expected summer travel months, where I believe the economy is going to tighten, and unfortunately the price of gas will continue to go down, and effectively the value of a stock in the oil and commodities or industrial sector will go down, generally speaking. Many people predict at some point that that's what's going to happen, particularly because what happens is when the Fed is known to cut interest rates, it is inevitable that the stock market will contract. So the indicators to me are like, regardless of what's going on in the short term, it's going to turn around. So if it turns around, I'm pretty sure that the oil sector will follow. In fact, it is the first one to be entering bearish territory right now. So I've decided it's the first one to go into bearish position. I've already put on a bearish position. I don't know how much longer it's going to last, because inevitably oil is volatile, and we've heard time and time again, when they meet, OPEC meets, sometimes they decide to do something wacky. And when they do that, like cut supply, the price is intended to go up, and all of a sudden your position, your calendar call can double, triple, quadruple, or more in value. So that's happened to me once already this year. So I am preparing to capitalize on this type of bullish maneuver, but I'm also going to hedge my bet. And I'm going to hedge my bet because technically we don't know when that precipitous rise is going to happen. So I'm prepared. I prepared myself with a simple $22 put position at the 18 price. But now I'm going to look at putting on a call a couple bucks above it. So let's take a close look again at what the options prices are today, and then we'll examine those positions the next couple weeks. Deal? All right. So to recap, we spent some time discussing how important it is to hedge your positions. I've put on a bearish position, and now I want to show you why there are signs of, um, you know, potential change in direction. Okay, first of all, we've discussed the extrinsic economic environment. We know that OPEC meets from time to time. They have meetings scheduled here in June where they're either going to say, look, we believe the economic conditions and the price of oil and the supply levels that we've picked are adequate to support an economic downturn, and we expect the economy to turn around. We expect conditions in China to improve. We expect China, conditions of lower supply and lower price to contribute to economic gains in the industry, and we're not worried. Okay. Or there's a risk that they'll say, despite our attempts to lower the price, it is not impacting our revenue, which we're trying to protect because we as OPEC nations have invested in capital improvement projects all over the region, and we just need to start paying back those loans. If that happens, there's a potential for a turnaround. But beyond those extrinsic factors, looking at the indicators on this chart, we've discussed already stochastics. The next one we want to look at is the relative strength index. And the relative strength index is also described as a momentum indicator. When we look at individual candlesticks and we compare the direction of the candlesticks alongside the volume, we can determine whether the momentum is strong or not so strong. When momentum is strong, it suggests that that direction will continue for a little while. So the two momentum indicators that we see here are giving us a distinct or unique perspective. The relative strength index suggests that we are still close to the mean of relative strength, meaning the momentum isn't particularly strong. So if it's not particularly strong, it is what I would say not in danger of losing momentum. And that's what momentum is all about. Momentum only continues for a certain amount of time, right? Like it eventually tapers off. And the momentum indicator shows the mean right around 50 is kind of where momentum tends to go. So it appears that our momentum isn't slowing down in the RSI. And that's good. That means my short position is a go. It means that there is room to grow in my short position. How much room? We don't know, but I'm certainly not closing out of a short position. I'm encouraged by the momentum. And when I see the Williams percent oscillator, which is a different momentum indicator, I'm seeing a slightly different picture. It appears on this chart that today we've broken down into what amounts to very, very, very strong momentum with a considerable lack of uncertainty as to how long that can continue. In other words, if you look at the left side of the chart where the price was about a week ago, you'll notice that the Williams percent momentum indicator was on the high side, or what amounts to a peaking in positive momentum. And that positive momentum is reflected in the strike price of those stocks, which is right around $24. What does that mean? If I take a bigger picture, which we'll look at in the next slide, it would suggest that the price has been increasing for several days until it got to 24 and approached what amounts to a peak in momentum in the positive direction. Since then, the stock has gone down, and you'll notice the percent oscillator there, the momentum indicator, has gone further down in proportion to how it had gone up previously, which suggests, in theory, that the momentum has run out of steam. And in theory, that the stock is due to return to a mean position and continue to go up. Now, that doesn't always happen just because the momentum indicator went out of its normal range. What it indicates is that it's starting to look like this move was very quick, almost sudden, and that it needs to be paid attention to. It's suspect as to how much lower the price will go. But if it does continue to go down, it may lose some momentum. We don't know how long that Williams percentage oscillator will be beyond the normal range, that extended period of time. But if you look at the positive momentum, you'll notice positive momentum near the extreme went on for 3 days. So if this continues to go for a couple of more days, that strike price could go down closer to $19, $20. What is that going to do to my short position? Well, we'll have to look. But it's gonna immediately make some profits, right? At which point we're gonna take the profits. But what we're trying to ascertain is using these momentum indicators. Is now the time to consider putting on a call option for right around that same time frame? And based on the 52-week charts in this discussion, that OPEC did its best to prevent capitulation on stock price, it's possible that by September and October, that stock price will go up. So here's what I'm thinking. I'm going to check the price on call positions for September, October, and print them here, and then we're going to look at them together. All right, guys, without further ado, in this video, we've covered an introduction to indicators, momentum, and now we're going to dive into identifying opportunities and what the price of those opportunities are. So I direct your attention to the right side of this slide. I read MRO, June 23rd, 2023, 20-some days to expiration. Those items that are in the yellow, that is to say, strike below 2250 there. Let me just double check what I've seen in an expanded view here. I'm sorry, those below $22 are highlighted in yellow, as you can see. That indicates those are the prices that are allegedly in the money, which is to say, if the stock goes up in value, the price of those options will simultaneously go up. In other words, when something is in the money, it means that it's of intrinsic value. And generally, intrinsic value is simply the amount of money that it is in the money. So if we look at the $21 call for June 23rd, we see the price of that option is either 167, 168, all the way to 178. That's a $10 spread between the bid and the ask. There is no demand, really. There wasn't any price action in the last hour that this was published. So we'd have to go all the way to the $22 call to look at the last price, which was $1.11. That is to say, by June 23rd, 2023, the stock is valued at approximately $23.11. What does that mean? If you agree to buy the stock at $22 today, in order to make money, that stock has to go up to $23.11. Okay? The stock presently is trading, let's see, double check what the stock is trading at here. Just one moment. The stock is trading presently $22.16. Okay, this is your introduction to stocks and options in a very simple way. The stock is trading at $22.16 today. If I want to buy the stock at $22 sometime between now and June 2023, June 23rd of 2023, at any point in time, I want to buy that option, which is 100 shares. Okay. In order to buy 100 shares at $22, I have to pay $111 to do it. That's what it's worth today for me to have the right to buy 100 shares or $2,200 worth of that stock between now and June 23rd. If I'm paying $1.11 or $111 because it's $1.11 per 100 shares, so I pay $111 today, I'm implicitly convinced that the stock is going to be worth more than $23.11 come June 23rd. Because I'm paying $111, which is to say I'm paying $1.11 per stock, per 100 stock. Each stock I'm paying $1.11 because I believe that stock is going to go up more than $1.11. Normally investments make money like 5 or 6% a year. But if I'm looking to make money in a shorter duration between now and June 23rd, and I'm pretty sure it's going to go up to 23.11 or higher, and I'm pretty sure I'm happy with a 10% increase in the value. So I want the stock option to be priced at $1.25, right? I want each of my stocks or 100 shares to increase 5 to 10%, right? Well, I need that stock price to go from its current value of what we said is $22.16 to roughly $23.50. Okay, that's what we wanted to do. By going up to $23.50, I've made a little bit more than $1.11, probably closer to $1.25. That's 10% on 100 shares. Okay. What if that stock decides to go closer to $25? The market will then value that prospective increase proportionately. So what we're doing today is learning about that discrepancy. We're going to take a snapshot of this chart tomorrow, the day after tomorrow, the day after the day after tomorrow, the day after that, until June 23rd. We're going to keep a log every night. We're going to look at it. Just to show you the power of options, okay? However, it is also the case that people implicitly limit their risk through such things as spreads, more specifically calendar spreads. A calendar spread is the purchase of that call, okay, at $22, but it's offset by selling that call as well. So in this case, I've published 2 dates, June 23rd and June 30th. Looking at June 30th, the price of purchasing the $22 call is $1.48. Notice that the 23rd, it's worth $1.11. The market is suggesting that if you give that stock another week, it's going to go up considerably, isn't it? It's going to go up from 111 to 148 in just that short week, which in and of itself is of interest to me. So again, I don't want to spend $148. It's a lot of money. I like to trade daily. I like to trade about $200 a day. So why limit myself to trading one stock with that much risk? Well, what if I say to myself, Ed, I'm going to go ahead and buy that 22 call for 148, but I'm going to sell the June 23rd position for $1.11. What does that mean? It means that at some point in time between now and June 23rd, that stock, which is currently in the money by 16 cents, may be taken away from me. I may no longer own it, and I may actually have to give it back. I may purchase it today and lose it. In other words, in order to own the right to buy the stock in June 30th, I risk losing the price that I paid for it. So this is a beginner's class. I don't expect you to understand it. We're just going to learn by example. Somebody believes that the stock could fall below $22. And if it falls below $22, okay, then I still have the right to own 100 shares. Conversely, if I look at June 30th, I own the right to purchase the stock at $22. So if the price goes up to 23, I own it. Okay? I want that right. I don't want to pay $1.48, so I'm going to sell the 111. That's a net purchase price of 37 bucks. Instead of $148, I'm paying 37 bucks for that price. I get to keep that right for 37 unless somebody pays me $1.11 for the right to own my shares. So because that's really confusing, we're going to look at a different strike price for the sake of simplicity. Stocks that are in white, they're out of the money. They don't add that level of complexity. To make it really clear, let's look at the $23 strike price. I want the right to purchase the stock at $23 between now and June 30th. It's going to cost me $71. Look at that June 30th stock. Call $23. Move under the last column. It's titled Bid, Ask, and Last. It's $71. I have a right to buy the option to buy 100 shares at $23 for 71 bucks. What does that mean? Technically, we believe that if I pay $71 and the stock is trading at $21.15, we believe that from $21.15 to $23, or $1.85, we believe that that's worth my while. We believe that that's worth my while. Topic for another day to go into the details of it. You're not experienced yet. For a beginner, the reason it's priced like that is because it's in a bear market right now. It means they don't believe that stock is going to turn around, which is why I'm looking at it. I only have to pay 70 bucks to own the option to buy it at 23. More importantly, if I look at the nearer date, June 23rd, somebody is going to pay me 60 bucks to own that call. Okay, so I'm going to sell that. That means if the stock goes over $23, I have to give away that position. Okay, and that's fine. But the purpose of this discussion is we don't believe it's going to get to $23 and that somebody's going to take away my option. Okay, again, we look at this on a daily basis. We'll go over it again. So instead of paying $71 for the right to buy the stock at $23 on June 30th, I'm going to pay $5. $71 minus, $8. $71 minus $63 for that $23 calendar. Okay, we're going to go over it tomorrow in more detail. I'm paying $8. That's not 80 bucks. It's not 800 bucks. Paying $8 for the right to buy MRO at 23 bucks sometime between now and June 30th. If the stock goes to 40, it's a $17 increase per stock, or $1,700 minus what I paid. $1,700 minus what I paid. $1,700 minus $8 is $1,600, whatever. Do the math. $1,600. $1,600, right? It's a lot of money for $8, right? It's not exactly correct to say that in that particular way right now, because we have to watch the math happen to understand it. Okay? But it's a no-brainer. I'm going to pay the $8 for that $23 stock. I don't care if the stock doesn't make it to $23. I care if it goes to 25. I'm willing to pay $8 for it. What you're looking at on the left here is an analysis in more detail of what these calendar spreads are. Looking from left to right, the first one says the price of $84. The date is June 23rd. I have to pay $96. Okay? $96, okay, to buy the stock at $22 or $22.50 on June 30th. On June 30th, I have to pay $96 if I want to buy it between now and June 30th at $22.50. Okay, $100. But I may also agree to sell. I may agree to sell somebody the right to have it if it goes over $22.50 for $80. That means I'm paying $12 for that longer term thing. And again, if you look left to right, take your time, pause the video, look at this, make sure you understand it. All we're doing is we're subtracting the June 23rd cost under the last column for the strike price from the June 30th price. So you'll do 105 minus 84, which is about $20. You'll do 71 minus 63, which is about $8. We've already covered. That's the one we're interested in. Or 55 minus 46, which is roughly $9. If you bought all three of those, you could make hundreds of dollars. Okay, we'll look at it again tomorrow. Thanks, guys.